Hey folks, good evening. Welcome to another Money Space with me, Kalu Aja. Of course, in our space, we are talking money, the economy, and of course, personal finance, right? We want to make all those topics really important to you, make you understand them, so of course, you can become a better investor and of course, a better citizen, right? So, we want to give you control of your money. That's what we're doing in this series, and this is the third and last part of what we're doing in this series. The first one we did financial health check, income and expenditures, right? And on that space, we talked around how you can track your income, track your expenses, determine your active income. I'm just summarizing, guys. So if you weren't here for the last two spaces, it's perfect for you guys to just catch up. So the first one was financial health check, income and expenses, where we talked around tracking your income, tracking your expenses. We broke down income into active income and passive income. Then we broke down your expenses into non-discretionary expenses and discretionary expenses. Of course, non-discretionary means the ones you have to do, like your rent and your food. And we said the whole idea in your income and expenditures is to ensure you grow your passive income. That's your objective. Grow your passive income. So when you are working, you are earning active income. Your objective is to convert that active income to passive income by investing it. So when you invest your active income, you take your salary, you buy shares, or you buy a fixed deposit, you are converting active income to passive income. And when you do that, you then get returns on the passive income. Your whole objective is that your passive income has got to pay your expenses. We said once that occurs, that means you can retire. Retirement is when your passive income can cover your expenses. That was what we talked around financial health check, income and expenditures. So we focused a lot on passive income, growing your passive income and all that. Then we did financial health check where we talked around assets and liabilities, right? And of course, net worth. We said assets bring you money. That's our definition. We're not doing accountancy, we're more or less financial planning. Assets bring you money. Liabilities take money away from you, or should we be fair, more specific, cash away from you. And then we said when you are starting off work, you don't really have a lot of assets. So it's okay to go into debt to buy assets today, because going forward, those assets grow in value and are able to generate income to pay off those liabilities. A good example is like buying a mortgage, right? You take a mortgage to buy a house. You've taken debt to buy an asset that over time the asset value saves you money or generates you income that pays off the liability. So on that note, we're talking around you making sure that your interest-bearing liabilities are used to generate income-creating assets. Your interest-bearing liabilities should be used to create income-generating assets. So we don't want you borrowing money to go on a holiday or to buy an Arsenal jersey. We want you to only borrow money to buy assets that generate income, because that income is going to be your passive income. So we're tying the income to our assets. So now we're on the third part of and concluding part of our financial health check, where we're now talking around the investing, because we've talked around passive income. We say you should invest your passive income. We've said generate income generating assets. But what are those income generating assets and how do we go about it? If we're 25 years old, we just got a job, how do we go from where we are today that in the next 25 years we're able to build a portfolio that can generate those assets, those passive income streams back to us? That's what we're going to talk around on this space today. And so if you're listening on Twitter, yeah, fantastic. I would also be on YouTube, so that way I can share a few of my screens, so that way you guys can follow. and you can see the visuals that I'm sharing, right? Again, most of the visuals also are in my book. So if you do have the time, this is Christmas. If someone asks you, what gift can I buy, or what do you want for Christmas? Tell them you want a copy of my book, right? Because all this stuff is going to be in that book, right? You can get all the stuff in that book, and then you are able to then say, hey, I want to follow it up at my own pace. That's most of the pictures we're going to share. So let's really try to start off by talking around the type of investor that you are. And I'm going to share that screen on Twitter. We first of all have got to ask ourselves the first question. What is your objective? Before you talk around investing, before you talk around shares, buying bonds and all that, you've got to know what kind of investor you are. Are you going to be an active investor, or are you going to be a passive investor? This is what kind of person are you? So I have a little, should we say, schematic here that will show you what kind of investor you are. If you know the kind of investor that you are, it allows you, right, to then know how you can approach your investing journey. The one thing you don't want to do is to say you want to trade by yourself when you don't have time or knowledge to do that. That's going to be a recipe for disaster. So as much as possible, if you do not have the skill set or the time to invest, then you want to basically get advice to do that for you. So very, very simple schematic. It's going to be the one that we're going to share today. I'm going to share it on Twitter. What we're asking you is to say, look at your objective and say, hey, do I have the time to invest? Do I have the knowledge to invest? Or do I have the skill set to invest? So if you, I'm just going to put it on Twitter. So if you just go back to the Twitter feed, you'll see what I posted there. It's going to be a very, very simple schematic. I will start from there, and then we'll just go down, and then we'll ultimately get to asset allocation, which is going to be the real meat of our discussion today. Again, if you have a question, I would prefer you request to speak, because when I'm the only host, I have to stop to read the messages. But if you request to speak, I can just listen to you and respond. Not a mandate, but I would prefer that you request to speak. So I've just shared that schematic with you guys on the Twitter feed. That just shows you how you want to approach essentially your investment journey, right? You want to ask yourself that question: do I have the time? Do I have the knowledge? And if you look at the schematic, it's asking, what kind of investor are you? Do you have knowledge? If you say yes, okay, do you have time? If you say yes, do you have the interest? If you say yes, it sort of takes you and defines the kind of investor you are. Some of you might have the knowledge and time, but you don't have the interest. Some might have the time and the interest, but no knowledge. Some might have time and knowledge, but no interest and all that. So it's going to put you either as a passive investor, active investor, or just a naive investor. You don't want to be a naive investor, which means you just want to make money, but you have no knowledge about what you're doing. So people invest, you go with them, you go with the wave, you're going to lose money. So the very, very first thing is to identify the kind of investor that you are, which is what we want to do in this schematic. If you know who you are, it helps you to then say, this is what I cannot do, and this is what I can do. Very, very important. Now, what's the next thing that we want to essentially do after we define who we are? Whether we're a passive investor, whether we're an active investor, whether we're a naive investor, we then want to then say, who are we? What kind of investor are we? And when we ask what kind of investor we are, we're trying to define what is our objective for investing. Why are you investing? And so I'm going to hold this chat up on YouTube, but I'm going to not read it out for you guys on Twitter. You have to answer these questions before you invest. The first, of course, being your objective. Why are you investing? That's your main objective. Why? Are you investing because you want to save for a long retirement, or are you investing because you have excess money and you want to pay your rent tomorrow? Your objective is very, very important. Your age, I say, is the most important thing that you want to find out. Your age determines how many compounding periods you have. So if you are 50, you would invest differently from if you are, say, 15. Because when you are 50, you have less compounding periods than if you are 15. So your age determines how much risk you can take, how much investing period you can take, and a kind of investment that you can take. When we get to asset allocation, guys, you're going to see this in practice. So your objective, your age, how long you are investing, and of course your risk profile. What would you do if, for instance, right, your assets fall in price? Would you sell everything, or would you hold on to the market for the next, say, 3 or 4 periods or 3 or 4 years and see what happens? So your objective, why are you investing? Are you investing for the long term, for the short term, for retirement? Because you can just make money and you have liquid cash just lying around. How old are you? Your age is your compounding period. If you are younger, you have more compounding period, which means you can recover from a loss. If you are older, you have less compounding periods, which means you cannot take a huge amount of risk because you cannot recover from a loss of investments. So we are converting these things to financial concepts by taking normal things that we see all around, right? How long are you investing? If you are investing for just 1 year, you have no business doing shares because shares tend to do better over time. So if you just have 1 year to invest, then no matter how good shares look, equities look, you can't go to shares or equities. You have to go to fixed income. What about your risk profile? If you don't like risk at all, you have no business being in cryptocurrency, in shares, or in any interest or any investment. The interest is not guaranteed because you have a lower risk profile. Again, special issues. Let's say, for instance, you're an ethical investor. You don't want to earn interest, like say riba. That will determine how you invest because even if the bank is making a lot of money, if you do not want to earn riba, then you will not invest in banking shares. So you've got to basically answer these questions. The first question is to say, what kind of investor I am. Am I an active investor, a passive investor, or a naive investor? Then you want to basically ask yourself, what's my objective? What's my age? How long before I need my money back? What's my risk profile? Do I have any special issues that would determine how I invest? These are very, very important questions that you want to ask yourself and essentially get that answer to, right? To then determine how you basically would deploy your investment. Let's share a second schematic also on Twitter. This one will also show you how we want to take you from asking these questions to the available asset classes. You have to try to follow a science-based way to invest. You can't invest. Last week we said it, you can't invest because the investment you are looking at is basically making money. You can't say, I want to buy this investment because it's making 25%. No. You have to invest according to your objectives. And what are your objectives? That's going to be your age, your risk profile, when you want the money back, any special circumstances. Those things determine your risk, your objectives, right? Determines how you invest. So let me share this one again. This is going to be a flow chart. We're going to introduce you guys slowly into asset allocation. And what is asset allocation? It is just the distribution or the allocation of your investments according to available asset classes to meet your objectives. So for instance, if you want to invest for retirement, then the way I would distribute your cash to different asset classes to meet your retirement goal, that's asset allocation. So if I come back to Twitter, I'm going to share it on Twitter now, and you guys can just go to Twitter and look at what I've just shared now. So what I've done here is to try to introduce the asset classes, which is your shares, your bonds, and all that, and now to link it to your age and all that. So those objectives, your age, how long you can invest, I've sort of linked both of them now. I just shared it now on Twitter. So if you go on Twitter, you should be able to see what I just shared. And let me see if I can also do that on YouTube. So they have that as well, and that should be fantastic. All right, so if you look at what I have shared, I'm just going to put that up on YouTube as well. Fantastic. So, all right, so if you look at what we've shared now, right, on the flow chart, you would see, the first question we really want to ask is, okay, how much risk can you take with your money? That's the question you want to ask yourself. You've got ₦1 million. How much risk can you take with that ₦1 million? What is risk? Risk is that how sure do you want to get that 1 million back? If you have, under any circumstance, you do not want to lose that ₦1 million, that means you have a very, very low risk. And you know what they say, it's not always correct, but they say if you don't take risk, you can't make a return. It's not correct in its entirety. But the point is this: if you don't risk your principal cannot grow. You know, there's a story in the Bible where the guy gave the servants talents. He gave one 10, gave one 5, gave one 1. And he said, go invest it. That's an investment story. The one with the 10 talents invested his money and got more. 5 talents invested his money and got more. The 1 talent guy did nothing. What did the master say? Even if you were going to do nothing, you could have at least given the money to a banker to invest, right? And at least you would have earned income. So if you don't invest your money, you can't earn anything. But once you invest your money, you have exposed it to risk. So the first question is, how much risk can you take on your principal? If you say yes, or if you say no, you see how it diverts. If you say yes, it's asking how aggressive do you want to be. So if you say I want to be, high volatility, I'm okay with high volatility, it's recommending asset classes for you. If you say, oh, I want very, very low to moderate volatility. Volatility is how we measure risk. So if it's if the returns are going up and down, or the prices, that means it's a very, very highly volatile stock or asset class. So what we're doing here is we're basically saying, hey, can you be comfortable with an investment going up and down, up and down, up and down? If you say yeah, okay, then we're giving you those asset classes that we think you want to look at to accomplish that investment. That's going to be on your left hand side. So high and very aggressive investment asset classes, because you want to invest your risk. It's not going to ask you, do you want high to moderate, moderate to low, and it's going to give you those suggested investment classes there. What about your investment horizon? If you want the money in less than 90 days, again, remember, this is giving you any way you want to do it. It's giving you the answer based on what your objective is. If you are looking at the timing, it's asking you, do you want your money back in 90 days? Of course, you can only then go into money market. You can't do shares if you have your money back in 90 days. So it's constricting you based on your answer. It's telling you, because you want your money back in 90 days, you can't do all those other asset classes. You just have to be in money market. Right? Do you want your money in more than 90 days? Yes. Okay. Do you want to get income quarterly? Yes. It tells you what way to invest. Savings bonds. Federal government savings bonds. You don't want your money quarterly? Fine. It tells you can invest in bonds longer term. If you want to do very, very aggressive, it's telling you, well, do crypto, do small caps, do private equity, because you want to take you can take a high level of risk with your money. It's telling you to go into asset classes like crypto, which are very, 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 very risky. You can lose all your money, but that's what you've chosen, because there's no free lunch. That's exactly where it's taking you to, which goes back to our initial point I made about that. Before you invest, you've got to ask yourself, what kind of investor are you? If you determine the kind of investor that you are, it determines if you are knowledgeable, if you are naive, or if you just don't have the time. Based on that, you're an active investor, you're a passive investor, or you're a naive investor. Then you want to say what kind of person you are. Are you a risk? Can you take a lot of risk, or do you need a lot of help and all that? Once you determine that, then your options then become a bit clearer. We can then see that if you want to do investment based on time, you have very, very limited options. But if you're a very, very risk appetite guy, you can take a lot of risk, then it's giving you those other investments. Let me try to make this easier for you guys again by using let's use a football analogy, because most guys will tell you say this, but using football to say this. So let's try to do asset allocation, right? And we're going to use soccer. So if you guys know soccer, we're going to use soccer or football to explain asset allocation. Once we do this explanation, we're going to now go and look at how you can build your asset allocation, right? If, for instance, if you want to do if you are an aggressive guy or you're going to retire, what kind of portfolio should you build? Remember, we're tying this into our income, our assets. This is now investment. We're saying you want to convert your active income into passive income by investing it. So this topic is saying, where should you invest it? And we're saying that you have got to invest according to your risk objectives, according to your duration, according to who you are. Are you an ethical investor? You don't want to earn interest. According to your duration. Those are all the questions you've got to basically go out and find out and invest according to that. So we're going to try to do this now. We're going to use soccer because soccer is a very, very good way for us to explain this stuff. We're going to use soccer and see if you guys can really get this asset allocation into your head. Why is this important? Because asset allocation is the key determinant to if you would meet your investment objective. Asset allocation is very, very key to determining if you would meet your investment objective. If you get it wrong, if you say you want to invest for 5 years, but you buy treasury bills, you've already lost. You're not going to make your objectives. So you've got to make sure that whatever you are doing, your asset allocation is addressing exactly what it is that you set out to achieve in the first place. Okay, so now I've shared the asset allocation as a soccer game. So let's just go to Twitter. If you're on YouTube, it's also shared on YouTube. You can see how we've sort of used soccer to explain asset allocation. So let's look at what we have here now. If we look at our field. Now, what we've said is that the entire football field, that's your financial market. So you've got 100 meters of soccer. That's where you're going to play your game. That's where you're going to invest. That's where you're going to buy assets and all that. Now, you have in soccer, we have three main players. We have the attackers, we have the midfielders, we have the defense guys. The attacker's job is to go score goals. The guys' job is to basically defend the other team from scoring goals. They want to stop it from losing. The midfielders are, they can go to attack, they can go to defend. So, sorry if you don't follow football, but if you follow football, it's going to make perfect sense to you. But if you don't follow football, you might still be lost. But this is going to make perfect sense to you if you follow soccer. If you look at what we have here, let's say you are Arsenal, and you are at the 89th minute, which means you are late in life. So this is like a man that is maybe 55 years old. You haven't invested. You are about to retire in 10 years, 65 years old. What should you do on your soccer pitch? If you look at this soccer pitch, Arsenal, any footballer will tell you that if you want to get a goal, what should you do? You want to go into attack. So you're going to put in more stocks, because stocks here are your aggressive investment assets. It is stocks that will grow your portfolio. So when you need goals, when you need to grow your portfolio, you are buying more stocks into your portfolio because you want to grow and score goals. You want to go from 1 goal to 2 goals to 5 goals, and your time is very, very short. You see the problem? So when you are taking in a lot of stocks, a lot of attackers, what are you doing? There are only 11 players on the pitch. You are removing players from your defense to attack. You are taking players away from your midfield to your attack. What happens if the other team has a counter attack? You have no defense, then they score you. So when you are 55 and you go buy stocks, it's like you are buying a lot of attackers. You can score a goal. Maybe you can buy crypto at 1 naira and it gets to 100,000 naira. So you scored a goal. Or you can go buy crypto at 10 naira and it goes to negative, which means they've scored you a goal. But because you are 55 years old and the time is very, very short, remember this is Arsenal at 85 minutes, you only have 5 minutes to score. If they score you, you can't equalize, the time is gone. But if you're a younger player or a younger aged person, maybe you are 25 years old, that's the same as Arsenal in the first minute of the game. 5 minutes into the game, they get scored a goal. They have 90 or 85 minutes to equalize. The same with you. If you're a younger person and you invest in riskier assets, you have more compounding periods to try to catch up in the game, your investment game, score, and to try to retire. Because the goal here, guys, is retirement with passive income. But if you are just starting the game, how should you line up your footballers? Well, you're going to say, I'm a younger person. I have 90 minutes to attack. So I'm going to play 4-4-2. Easy, simple. I have 4 defenders. I have 4 midfielders. I have 2 attackers. I can score. They can't score me. I'm taking balanced approach. But balanced approach, we all know, guys, is not risky, right? If you have 2 attackers, can you score with 2 attackers? Does Arsenal have 2 attackers? They have wingers. They have more people attacking. So what will Arsenal do? Arsenal will ask his defenders to overlap. What is that overlapping? That's you borrowing money. You are taking defenders from your blue, which are your bonds. You are saying, because I am younger, I don't need bonds. I can survive without bonds. I don't need defenders. I'm going to go on the attack and buy a balanced portfolio or a stock-based portfolio, and I'm going to try to attack because I want to grow my portfolio. My objective is capital appreciation. That's what you're doing here in soccer. So when you are younger and you can take more risk, which is like a footballer that has more time, the game just started, you have all your team bent, nobody's injured, you take more risk so you can score a goal. But if you are now getting older, maybe you've scored 2 goals, what do you do in soccer? You take off your attackers, you bring in defenders, you bring in defensive midfielders. You are saying, I've already scored 2 goals, so I want to defend what I have. It's the same as you saying you are at about 45 years old. You have your mortgage, you have a small bills on the side. So now you want to sort of pull back on taking risks. You want to protect what you have by bringing in defenders. Who are defenders? You now want to transit your asset from stocks back to bonds. So you go back into the middle. You are saying, okay, now I'm going to take away my attacker. Maybe I'll take away 1 attacker and bring in 1 midfielder because I want to protect my portfolio. Right? That's what you're trying to do. You're trying to protect your portfolio from this. That's what you're essentially trying to do. And of course, you can see that you can look at this as in many scenarios. You can look at it as if you have 5 minutes to go, you want to bring in more attackers, because if you don't bring in attackers, you can't make any money. If you are retiring and you haven't saved, you have to bring in attackers, even if at the risk of losing money, which is a bad thing because you should have saved for when the game started 90 minutes ago. So when you don't save, you are exposing yourself to risk because you are going to try to play catch up and you can get caught on the counter. This is the whole idea of how investing works. If you do not save when you can, you are going to get caught up in the counter attack. Guys, I'm going to stop here. I have another slide to share. We're going to go more into asset allocation. Let me take a quick question from Baba, and then we'll sort of go back and look at the comments. I have a few comments that have come in. I'll just try to read them as much as possible, and then we'll just continue. I have one more infographic to share, and then we'll open up the floor. You can ask a question if you want. Baba, how are you doing?
Hi, I'm good. Can you hear me?
I can hear you very well. What's your mic, sir?
Good. So it's not really a question. It's a how do I phrase it now? It's just a comment, right? And I'm not sure if I understood you clearly or not. But I wanted to refer to the scenario in which you are almost at retirement age, right? And you have no savings, no investments, nothing, and you are trying to just make something happen in the last minute. What I think is the standard approach in that kind of scenario is that you actually don't increase your risks. What you do is you postpone your retirement age, because at that age there's no magic that you can perform. So you increase your retirement age and you still try to make your asset allocation as widespread and as diversified as possible. I think that's the only thing I wanted to point out that came out to me. The other, I really love the football analogy. and the other things you said were 110% spot on. Thank you.
Yeah, the question for you, Baba, what if you are 75 years old?
Well, I see where you are going, but the truth is that is it Maxwell's law or something? If something can go wrong, it will. Trust me, if you increase your risks, you will pay for it very, very dearly.
Correct.
The market will really mess you up. If you are 75 years old, you don't have any investments, no savings or nothing, the first question people ask you is why.
Correct.
I live in Canada, and one of the things that I see very often is you see old people who, at least if they have good health, if they are blessed with good health, you see them, they are still working. They are working minimum wage jobs. And if you get closer to them, you'll find out that these people are not necessarily poor. But there are people who somehow just didn't start investing or preparing for retirement early enough. So the money they're getting in their retirement is not enough for them.
Sure.
So honestly, the truth is that there's really nothing you can do. Maybe you go and survive with your grandchildren.
Exactly.
If you put the small money you have out there and you put it in risky investments, you will pay for it. Almost 100% certain, as far as I know. Yeah.
100% correct. That's the point we're trying to make with this football analogy. If Arsenal had refused to score a goal from the first minute to the 88th minute, they are desperate. They will send their goalkeeper. You know, in football games, when the goalkeeper goes to score, right? When there's a corner kick, the goalkeeper will run to the other half pitch to try to score. The time here, there's no goalkeeper, there's no defense, there's no midfield. That's you being desperate. That's not football. You've spoiled the rules of football. You should have tried to score a goal in the 90 minutes. So you avoid the situation where you are now deploying risky strikers, risky stocks to your portfolio. That's the point we're making, Baba, and you are totally correct. You don't want to do that at the 88th minute. You want to avoid a situation that you are retiring, but you still have stocks, and that you are trying to use those stocks and grow because now you look at capital appreciation. That's what stocks are doing. Look at how we put it here. Stocks, aggressive investors use equity to achieve capital appreciation goal. You don't want to be doing that when you are 75 years old, because as you are getting older, you are taking away your attackers and bringing in midfielders. At 75, you should only have defenders. So when Nigeria was trying to qualify for the first World Cup and we had 2 minutes to go, what was Nigeria doing? We packed 2 buses in front of Algeria. We're no longer interested in attacking. We packed the bus. So Algeria was bringing in attackers, we're bringing in defenders, because we want to protect what we have. That's how you do it in football, right? You want to avoid Real Madrid getting a header at the 95th minute and you don't win the Champions League. That's the whole idea. If you wait, that's all this series we're doing today is to tell you the one thing: passive income, passive income, passive income. If you look at this chart, what is going to give you passive income? It's not stocks, it's not balanced, it's more of the bonds, where you don't have to do anything and it's guaranteed return. Yes, the stocks will give you dividends, but stocks can disappear. Bonds are more of your bottom box, your bottom of the pyramid. So the whole idea is don't wait to the 95th minute to buy stocks, which is what many people are doing today. Many of us, if we look at our portfolio, we are trying to catch up because we didn't invest years ago. And if you are playing catch up, you are taking away your defenders and midfielders to introduce attackers, and you may get punished. Baba, excellent observation. You are totally correct. That's what we're saying. Don't do it. Don't get to the situation whereby your goalkeeper has to run from his own end to your own end to try to score a goal in the 95th minute. It's already too late at that time. Invest early, start early, and grow your portfolio early. Time will work in your favor. Fantastic comment, Baba. I appreciate that. Based on what Baba said, let's look at our last infographic that I want to share with you guys, right? This is now going to show you how we want you guys to pool your portfolio. This is going to basically line up the asset allocation, and your objective. Now with the asset classes, we've showed you the football scenario where we are saying, listen, look at your investing at the football game, right? Now let's try to show you this same scenario, but now with asset classes and even percentages. So I want to show you how you can then do this. Again, I'm going to go to Twitter. I'm doing on Twitter and also on YouTube. So forgive me, I'm sharing on both of them. I'm going to go to Twitter and share this so you guys can take a peek at it before I go to YouTube and also share. So Twitter, here we go. What I'm sharing here is going to be according to now asset classes and also by age. So this will make more sense. This will capture what Baba is asking and also make it more clear where we want you guys to be. Again, guys, this is not investment advice. I'm not your investment advisor. This is more of education, right? I'm giving you the DNA of investing. I want you to go meet your advisor and say, I heard this guy talking about this. What do you think? And he can then give you more advice. I'm giving you education, right? More or less a lot of education that you can then go and get more knowledge on. So, guys, if you look at Twitter, I've just shared that infographic on asset. Take a peek at it. I'm going to come back to it once I share as well to the folks that are following on YouTube. There we go, guys. All right, there we go. Okay, so what do we have that is shared as well? Let's go to Twitter. This is the objective-based asset allocation. This objective-based asset allocation is now capturing your objective, the asset class, which is shares, bonds, stocks, but it's also giving you how we want you to progress from when you are a 25-year-old and how you want to go till when you're like 75 or when you retire. So we're sort of progressing you across the board. If you look at what we've done here, we've picked three objectives, two broad-based objectives. There's aggressive. Aggressive simply means you want to grow your principal. That's what aggressive means. You want to grow your principal. Hear the words, grow your principal. Conservative means you want to add money on your principal. When you are growing your principal, you are going from 1 naira to 2 naira. The principal is growing. So it's growing. When you are a conservative investor, you can't grow your principal. You can simply earn from your principal. Let me say it again. If you have 1 naira and you want to be aggressive, you are trying to grow that 1 naira to 2 naira or 10 naira. So you want to grow the principal. But when you are conservative, you can't grow that 1 naira. You can only earn on that 1 naira. That 1 naira can earn you 10%, even 100%, but the 1 naira is not going to grow. You are only earning on that 1 naira. So if you look at our chart, we have aggressive, which is our attackers. We have moderate, our midfielders. Then we have conservative, our defenders. So when you look at yourself, find yourself on this chart. If you have 10 years to retire, so you have more than 10 years to retire, which means you are like 35 years old and retirement is about 65. So you have more than 10 years to retirement, then you are on that column aggressive. And that's what educationally we think your peers are doing. What if you are conservative, which means you are in retirement? Look at moderate. You have 0 to 10 years to retire. Look at what your peers are doing. Let's take it in detail now. If you look at aggressive, how is he invested on an aggressive portfolio? He has no cash. There is no cash investment in this portfolio under aggressive. Why? Because he wants to grow the investment. If you keep cash, it's a waste of money. Why is it a waste of money? Because cash doesn't earn anything. When I mean cash like, forget Nigerian cash. Nigerian cash is fixed deposit. That's not what I'm talking about. If you just hold cash, there's no return on cash. There's liquidity, but there's no return. So he doesn't want to hold cash because he's a very, very young person. He wants to deploy his footballers to play the game, to earn him a goal, not on the bench. If you hold cash, it's like you're putting players on the bench. So there's no cash. That's the first thing. Look at his biggest investment, 50% of his investment is in stocks. Why? He has a longer time to invest. He has 90 minutes to play the game. If they score him, he has time to equalize. Also, stocks over the long term tend to perform, should we say, better the longer you are invested. So he's taking a longer view to hold more of his investment in stocks. You see what he's doing? What's the next thing he's investing in? Alternatives. What are alternatives? There is maybe property, there is Bitcoin, there is private equity, things like that. So 80% of his investment is in very, very risky, what we call risky. Why is it risky? Because the principal can be lost. But why is he doing it? Because he wants to grow his portfolio over time. He can take more risk because he has more than 10 years to retire. That's what he's doing. 20% is in bonds. He's saying, even though I am Barcelona and I am attacking, I also have Puyol to defend me. That's what bonds are. Bonds are your insurance. Bonds defend the portfolio from a loss, a recession, or a turnaround in the market, right? So he still has 20% in bonds. You can go into this portfolio and tweak it. You can say, well, I'm going to do 60% equities, I'm just 15, or I'm going to do the 25% in bonds, I'm still not that risk aggressive. You can do that. This is like a broad outline of how an aggressive person with more than 10 years to retire is going to approach his portfolio. Let's go to the guy that is conservative. And when we say retirement, it could be you are near retirement, you have 5 years to go. Look at the 5-year retirement guy. He's investing in cash. Cash could be bonds, cash could be federal government treasury certificates, it could be treasury bills. But he's got about 30% in cash. Why? This stage he's at is what we call the spending stage, the gifting stage. He's no longer investing, guys. When you get to this stage, you are not trying to buy crypto to make, no, you're done. You are at what they call, you are building a legacy, you are investing, you are eating from your passive income. At this age, you are eating from your passive income. Every time the federal government posts federal government savings bonds, I always come up and I say, these savings bonds are for income. And every time people will say, it's not beating investment, it's not beating inflation, sorry. Why should I buy an investment not beating inflation? You buy it because you want to earn income. Who wants to earn income? Retirees or near retirees. Or even people that want to pay their rent next year and have money today. They are not investing to, remember, to grow the principal. They don't want to appreciate the principal. If I have 1 million, my rent is 1 million next year. My job is not to try to grow that 1 million to 2 million. That's too much risk. My job is to make sure I still have that 1 million. If I have small jar on top, I'm fine with it because I just have 1 year and I must have that principal. So I will go and buy a federal government security that is the safest investment in Nigeria. It might not beat inflation, but it's going to give me back my principal. Return of principal is more important than return on principal. I say it again, return of principal is more important than return on principal. That's why you buy federal government bonds, because they are safe. You want your money back, you don't want to hear a story because you're a retiree, or you just your money for your education, or you're doing something specific with it. You don't buy shares with that money. So at the guys at retirement, what's he doing? Now he's looking at his cash. He needs liquidity. He's got the bulk of his funds also in bonds. What are bonds? Bonds are giving him return. What's it called? Bonds are giving him returns, i.e. passive income returns. He's not taking any risk whatsoever. Yes, he's got some equities there. Look at where he has little teeny-weeny equities. It's very, very small. I think he's got alternatives. Then he's got 15% of his investment in stocks. Also saying, hey, yes, I know I am risk adverse, but I'll just put 15% in stock. Really, just 15%, just to give my portfolio some sexy boost there, right? But I'm not here to make money, right? That's what he's trying to do. And that's how we want to approach this. We want to approach investing solely based on our objective. We don't want to do investment according to returns, which is the error that we make all the time when we are chasing stocks and Bitcoin, but not asking what is, for instance, our objective, what is our risk profile. That's what we're not asking, and that's why sometimes we get into trouble. And that's why I want you to do this whole series, to come back now to this. So if you now look at this portfolio, what we're now saying is that you then have to invest according to that objective, because you want to achieve that passive income. You can't wait to invest, because the more you wait, you are becoming like that player that has waited for the 90th minute. You then have to send in all your attackers and all your defenders to go and score a goal, and that exposes you to risk. All right, guys, fantastic. So again, there are lots of questions on the DM. I have to stop and read them. If you have a question, ask on the just request to speak like Baba has done, and I can just take them real quick. I don't have to read, but now I have to stop and read them and then come back to you. Yeah, so just, yes. So, to our stocks. So, stocks as a whole, right? Somebody's asking here, are all stocks risky? Like, she's basically making the point that what about blue chip stocks? Are blue chip stocks risky? Because I understand that small cap stocks can be risky, but are blue chip stocks risky? Yes, I get the question you're asking. In stocks, we have blue chip stocks that are, should we say, less volatility, right? So if you buy, for instance, if you buy Dangote cement, right? Yes, I get what you're saying. Dangote cement is not going to really crash in value when you compare to, say, other stock that's a small cap stock. I get it. If you also go to America and you buy, say, Nvidia, right? Yes, Nvidia is not going to crash in price maybe when compared to other stocks. I get that question. But stocks are what we call variable income security. Dangote can never tell you that his stock will pay you X amount of money next year. He can only tell you what his stock will pay him yesterday, not next year. So because you are not guaranteed, remember, who knew what COVID, who saw COVID coming? Nobody saw COVID coming. If COVID happens tomorrow, what investments are going to fall? Stocks. It doesn't matter if they are good, it doesn't matter if they are bad. All stocks are going to fall. What investments are going to be stable? Bonds. Doesn't matter if they are good, because bonds are fixed income, stocks are variable income. So when you are building a portfolio, you cannot say, okay, I'm going to buy blue chip stocks, and that sort of takes away the risk of stocks. No, it reduces the volatility. In investment, we call it the beta. It will reduce that, right? But it's still variable income. Anything can happen to stocks, and when it happens to stocks, then your retirement is gone out the window. That's the whole idea. And I'm talking to you very great comment you've written down. Blue chip stocks are less volatile. I agree, but stocks, you cannot build a portfolio when you are 75 that is only based on stocks. You are exposing yourself to an event that could wipe away those assets because they are variable income built on earnings. Bonds, on the other hand, are guaranteed, especially when you buy federal government bonds. They are guaranteed investments. They are basically saying that whatever happens, we are going to pay you this amount of money. So what you want to do is you want to do a risk, what's it called? You want to basically do the allocation. That's what we're talking about today, asset allocation. To say, I'm going to do an asset allocation where there will be stocks and there will be bonds based primarily on my age and all that. Because if you don't do it that way and you have an event, you can look at what's their name? You look at a good example. Look at the final between Bayern Munich and Manchester United. Bayern Munich was leading 1-0 till the last 5 minutes, and Man U scored 2 goals. That's what can happen to your portfolio. You can be making money for the next 90 for all the years of your life, and the final year of your retirement, you could have COVID-19, and your portfolio will go from 10 million to 1 million. It's happened before. So Again, you have to do that's taking my time to explain. You have to do an asset allocation according to your age. You can't say you want to take risk at an older age. That's not an option. Don't say it's I'm hearing you, I'm reading you. Don't say I can afford to take risk. No, don't say that. I'll give you that one as financial advice. You can't take risk when you are older, because if anything happens to you, you cannot walk your way out of it. What I mean is, you cannot, like Papa was saying, you see guys in Canada working very, very long. They don't retire. But those guys have got a pension, or they've got something. You can't afford to work when you are older. What if you break your leg? You're already 90 or 70. Your leg can't heal as fast, right? So you want to make sure that you avoid that situation. Yeah. Okay. I'm just going to share this. Someone is asking again, how do I do this? Yeah, that's a good question. I didn't want to share too many slides. Someone said, hey, let me just do age, and I'll share this one real quick with you. This will explain it for you. Someone is asking, so how do I go from aggressive to conservative? Do I have to buy? No, good question. I don't want to go into that. What you do, this is what your advisor will do. It's called the rebalancing. Most times, if you look at your retirement fund, if you work in a company that has a 401k, they will tell you, for instance, that we have a lifestyle fund. They call it it's a lifestyle fund, where they will ask you what year you are retiring, and then based on the year you're retiring, they will basically give you a portfolio, and every year that portfolio will change automatically. You don't have to do anything. PFAs also have it. If you go to Nigerian PFAs, based on the year you are retiring, right, they will give you, based on your age, which is the same as your year of retiring, they will give you a portfolio. There's Fund 1, Fund 2, Fund 3, Fund 4. Those funds are doing what we are seeing. When you say you are Fund 1, they are assuming that you are going to be aggressive. So they give you a portfolio based on that, right? Or if you say you are Fund 2, they assume you are going to be conservative. So they also give you a portfolio to align with your conservative objective. That's what they're doing. So the way you do this is there's something called a rebalancing. With the rebalancing, you are essentially going to move from equities to bonds automatically as you get older. There used to be a rule of thumb that says that you take your age, you minus 100 from your age, and that larger number is what you want to put in equities. So as you are getting younger, you are essentially now saying, okay, maybe in 5 years or 2 years, you are going to rebalance your age and say, as I'm getting older, I am trending towards bonds. Again, it's not automatic. You don't have to say, oh, I must do this bonds. But overall, have it at the back of your mind that you cannot have the same portfolio as a 25-year-old as a 50-year-old. You can't have the same portfolio. You have to take into account the fact that as you get older, you want to essentially have a better allocation. Again, I just shared something on Twitter, right? That explains it better. If you look on Twitter, you see what I put down. All these infographics are from my book. Everything I'm sharing here are from my book. So the book has got tons of all of these for you to follow. If you look at what I've shared again on Twitter, go back to Twitter, guys. You will see where we've done the age distribution. Exactly the same thing we're talking about, which is the conservative, the aggressive, and the balance. But we'll sort of stretch it out over time. So you can see this guy, he's below 35 years old. What's he doing? He's doing 100% in equities. But he's 35 years old, right? Then the guy gets to 40 years old. What does he do? He reduces his 100% equities to 80%. So now he has 20% bonds. He gets to 45 years old. He has done 60-40, the most popular 60-40 investment that everyone seems to have. At 50 years old, he's doing 60-40, but he has flipped it. He has said 60% going to be in bonds and 40% going to be in equities. When he's above 50, he's totally flipped. He's now at 80% fixed income, 20% shares and all that. Why? Remember that word again I keep on using, passive income. He's trying to achieve passive income. And the way he wants to achieve his passive income here is to invest in income generating assets. What's the best passive income that you can get? Is owning your own business. The bulk of the quote-unquote millionaires you have all over the world, in America, in the UK, in Nigeria, all own their business. They all own their business. I'm not talking about owning a cement factory. I'm saying owning a restaurant or owning a taxi company. Just owning your business exposes you to having wealth. But owning your business is not passive income, right? If you own a company, it doesn't mean it's passive income because you have to go to that company day in, day out to work. But if you can structure a relationship whereby you can say, I own this company, but I don't have to go to work every day. So I own the company, but somebody else is managing the company for me, then that's passive income. So don't get it, try to keep it on the term passive income means you don't have to be there to earn the return. So because you are the chairman CEO of a company, it doesn't mean that alone is sufficient. You've got to have a structure where if you don't go to work the next day, that company can survive without you. That's where we're going to with this passive income. Yeah, fantastic. So that was a good question. I'm just scrolling through the really good ones that I can share. Can you put up the infographic on YouTube? Oh yeah, it's gone off. Let me put it back on. Let me put it back on for you on YouTube. Yeah, so you can see that. Yeah, and just yeah. I'm not trying to plug my book. Just get the book. It's all in there. I try to put the pages in there for you, and you can basically see them there. What else? Can you explain what bonds are? If you have to explain what bonds are, bonds is an IOU. So when you have a bond, you are lending money to someone. IOU. When you buy a bond, you are lending money to the government. Let's say you buy a federal government bond. Government wants to borrow money from you, so you lend them money. They give you an IOU called a bond. So the government will say, we're going to borrow money from you, and every quarter, in Nigeria they pay quarterly, we're going to pay you interest every quarter. At the end of the bond period, we're going to give you back your principal. That's what a bond is. So when you buy bonds, you are going to take 10 million naira, for instance, and give the government. Then the government might pay you back 100,000 naira every quarter. They pay you the interest. At the end of the 10 years, they give you back your 10 million. What's the risk? Inflation. You can buy a bond today, and because of inflation, because they are paying you back a fixed income, inflation will render that 100,000 naira worthless. That's the risk, that inflation will render your fixed income worthless. But what's the alternative? You cannot say because of inflation you are going to go and buy risky assets when you are older. So you've got to have a mix, a portfolio. You can buy property, you can buy bonds, you can buy crypto, but it's got to be a mix so that the combined return gives you something profitable, but the combined risk is reduced because you have it in a portfolio. Does that make sense? You don't want to put all your eggs in one basket. Yeah? Okay, fantastic. In Nigeria, do we also have? Yes, this stuff I'm sharing with you, when you have aggressive portfolios, conservative portfolios, is what every investment firm uses. When you go to a Nigerian investment firm, I'll just share with you, the PFAs have Fund 1, Fund 2, Fund 3, Fund 4. This is what they use. This is exactly what they use. They use these funds to put you in aggressive. So if you notice Fund 1, they will tell you if you are this age, join Fund 1. That's because that Fund 1 does more in equities. So when they tell you that you want to do equities, they are pushing you towards higher risk. Because you are younger, you can take higher risk. But look at when you go to Fund 2, what they tell you. If you are young, if you are older, they put you on retiree fund or Fund 3. Fund 3 has more of its investments in bonds, not in equities. So it's the same thing they are doing. Every investment firm on earth they use the same principle. It's the same principle that we use. They call it some people call it pie charting, right? You say who are you, then they put you in a pie chart. You can customize yours a bit. You can say, okay, I don't want to be in this percentage, or I want to have maybe this and that. You can do all that, but the broad ideology is the same thing that we have today as we've had yesterday. Who are you? Based on who you are, you then invest according to who you are to achieve an objective. So objectives are left for you to determine. But we have some general rules we like you to follow. We don't want you to have an objective where you are investing in risky assets as you are older. That's not a good objective. You are mismatching your objective. You can't be taking in more risk as you are getting older. And number two, based on your tenure, when you need your liquidity back, you should invest based on that liquidity, which means if you want your rent money back the next day, you should invest that you want to get your rent money back the next day, not because of the returns on the profitability that someone is offering to you. Yeah? Okay, so someone is asking, what is Bitcoin? Is Bitcoin itself conservative or aggressive? Just my opinion, right? Just my opinion. Bitcoin is still an aggressive asset class. It's not conservative, even though it's Bitcoin. If you separate Bitcoin from the others, Bitcoin seems to now be accepted by Wall Street. I read a report the other day where JP Morgan is saying that they can use they can use Bitcoin now as collateral to get a loan. So if you have Bitcoin, you now have an asset that has come through, that banks in the US now accept it. But it's an aggressive asset, which means it's a risky asset. It can go up 10,000 today, fall 10,000 tomorrow. So I wouldn't look at it in terms of, I would look at it this way, right? If it's in your portfolio when you are younger, it's fine. As you get older, try to reduce the incidence. There are many ways you can insulate your Bitcoin. Some people do what's called staking. You can take your Bitcoin and lend it out to the exchange, and they can give you a fixed rate of return. And I don't know if you can do that with Bitcoin. Can you stake Bitcoin? Who knows? Can you stake Bitcoin? If you can stake your Bitcoin, that's a way for you to hold Bitcoin and also earn fixed income from it. If you can do that, that's fantastic, because then you have both worlds. You have the risky asset that's going to grow in value, but you also have the fixed income. Sort of like what property is. Property is like giving you best of both worlds. You have the property that's going to appreciate in value, giving you that protection, but you also have the return that comes from rental. So you want to basically look at that portfolio and build a portfolio. You can't have just one investment. You've got to have a portfolio. So that way, if one is falling, one is rising. I'm not sure why I'm not able to put that up on the Twitter. First, let me cancel this anyway. All right, fantastic, guys. So I see your question. So let's see, how long do we have? We spent an hour talking. I don't see anyone requested to speak on the video. If you guys want to speak on the video, that means our job is done for the day, and we'll call it a day for you guys, and then we can all go back. Just a lot of messages. I hope I can read them. Let me see. Okay, yeah. So this is I just sharing this on YouTube. Yeah, just share this on YouTube. This is your age-based allocation. So this is what, when you have an advisor, you have to make sure that you are meeting with your advisor at least annually. Yeah, you want to go over your allocation and say, hey, we started off with 25% equities. I have a child, or I'm married. Should I change that out? What should I do? This is what you should be asking. If you have a composite plan, right? You can't just say, I want to invest to make money. Your plan has got to align with your objective. And you see, we're starting from income and expenditures, and then we've moved over to assets and liabilities, and now we're investing. There's still debt. We haven't talked about debt. We haven't talked about retirement. We haven't talked about incorporating a company. There are lots we can talk about in finance, but if you don't get this very, very basic one right, then everything is going to be messed up. I've got Ola. Hey, Ola, how you doing? Ola Otu, how you doing? Ola.
Can you hear me, Lakalu?
I can, sir. How are you? How's your day today?
Fine, thank God. Sorry, and great work, great explanation, and some of us will have about 10 to 12 years to retire, and this is a masterclass for us.
Yes, sir.
Honestly, this is a masterclass, and I hope one day we're going to be paying for all of this royalty. Then another one, sir. You spoke about NME NPC numbers last weekend.
Yeah.
Honestly, I've been trying to scramble it around, but I can't find it. I don't know whether you can perhaps drop it in your YouTube.
What is that? The annual report or what?
Yeah, the annual reporter.
Send me a DM. I'll send it to you. If you go to let me look there and see if it's still there.
No, I don't know. I wanted to know. So I wanted the video, your explanation around the numbers.
Oh, okay. So the recording, if you go to we do a podcast, right? So all the episodes are going to be on the podcast. Just go to the podcast and you get it there. It's already saved.
Okay, so unfortunately I tried to go to the exactly for what do you call Apple ID.
I see.
Apple ID is messed up, right?
Okay,
right,
I'll send you the. Okay, just make sure you send me a DM. Let me send you a DM. Let me send you a DM.
Okay, all right, boss.
So that way, just remind me. I just put the dots there. Remind me, and I will send you the Spotify or whatever. Yeah.
All right, boss. Thank you.
You're welcome.
Thank you, boss.
You're welcome.
Thank you.
Yeah. Benga, hi Benga, how you doing?
Yeah, I'm very good. Thank you for the education.
Thank you, sir.
I just want to ask him your opinion about bond and maybe treasury bill. Will you consider that as a hedge for inflation? Like your money is not, you are not really making a profit, but your money is just growing in line with inflation.
Yeah.
Do you agree with that?
No, not really. But treasury bills and bonds really don't beat inflation. No, in Nigeria, no. In America, they also don't. But Americans have this product called TIPS, Treasury Inflation Protector Security, that does beat inflation. But we don't have that kind of security. So when you just have a bond or you just have like a T-bill, it's not going to beat inflation. It's not designed to beat inflation. It's designed to give you income. Right, that's the problem. So it's not going to beat inflation. If you are buying those investments, you are buying them for income to add to your portfolio to just give you income in that portfolio. Correct?
Yeah. Will you advise someone that lives in abroad to convert their hard-earned currency to naira to buy a Nigerian bond for a long-term approach?
It depends. It depends. I mean.
Or will you advise them to invest in the country they have, maybe buy the bond or treasury bill in that country?
People ask me this question all the time. The answer is this: what currency are you going to spend in 10 years? When you get the money back, what currency are you going to spend?
Still in the hard currency.
Okay, let's use real life examples. So right now, let's say you are in the US right now. What are 10-year treasuries paying you? About 4%. Let's just say 3 to 4% US dollar. 3 to 4% US dollar. So if I buy US treasuries, I'm going to get 3 to 4%. What's inflation in the US? 2%. So I'm making money. That's real income in dollar terms. Let's come to Nigeria. If I buy Nigerian 10-year bonds, they're paying me maybe about I don't think they'll pay more than 15%. Inflation rate in Nigeria is about 19 or so. So I'm not making a real return. But your question is saying if I take my dollar and I sell my dollar and I buy naira, so I have a lot of naira, and I then buy treasury bills and I make that 19% in naira. So I've made money because I've come from dollar to naira. I got more naira. Because of the devaluation of the naira, I got more naira and I bought Nigerian investments and I made a Nigerian return. That Nigerian return has not beat inflation. That's number one. Number two, when I convert that money back to dollars, I don't know what price I'm going to convert it back on. In 10 years ago, I think 15 years ago, Nigeria had a forward market where you could go and buy dollars 5 years ahead of time. If that sort of market existed today, right, I could know exactly what my exchange rate would be in 5 years or 10 years. I could buy and hedge my exposure, and I can give you an answer. But today, I don't know. If I want to convert my money and the money is at 800 naira to $1, wow. So, I've lost money, So we can't tell, we don't know because we don't have a forward market, really. That's the problem, George. We don't know. Yeah. So because we don't know, The only thing we can do to say invest in the currency that you want to spend in the future. That's what we can say.
Yeah, that makes sense. Thank you very much.
You're welcome, man. If I request to speak, I don't see him again. Oxley, hi. Oxley, what's up? Oxley Tech. Don't want to fix your mind. Alright, guys, so I'm back to this before we just round it up. I don't see a lot of guys. Really, the messages are just a lot, so it's really difficult to read them because some are duplicative, but I do see a lot of good ones here. What is APY? Yeah, so just a good question on the bond returns. When you want to compare bonds to equities, don't look at the coupon. You want to get what's called the yield. Same thing with property. If you want to compare, don't compare dividend to yield. No, look at the yield across the board. So you say, what's the rental yield? You compare that to the coupon, the yield to maturity of the bond. You compare that to the dividend yield of the security. You don't compare they are paying 12 naira in bonds, but they are paying 2. No, that because you get a wrong answer. So you convert all those numbers to yield. So for rent, it will be your rental yield. What is rental yield? The rent you are getting divided by what you used to build the house. The rent you are getting divided by what you used to build the house will give you your rental yield. That's your rental yield. What is the coupon yield? The coupon you got divided by what you used to build. That's dividend yield. The dividend you got divided by what you used to buy the stock. That's your yield. Same thing with your yield to maturity. That's a bit more complex. That's for bonds. So you compare yields across the asset class. That gives you the return that you want to compare. Don't compare the dollar they are giving you or naira they are giving you. You convert that dollar you are getting, the dividend naira, to a yield. Then you compare. So if the yield for bonds is higher, that's what you want to go with. Not if the naira they are giving you is higher. I'm not sure if I made any sense there, but you compare the yield, not the naira they are giving you. Oxley, can you speak? I'm going to move on. Let's get Osawaru.
Yeah, good evening.
How you doing, sir?
Mr. Carlo. Yeah, the last question you attended to was what struck me was you said the currency you're going to spend in the future. Like in the UK, if you put, let's say, fixed deposit, for instance, is around 2% per annum.
Mm-hmm.
But in Nigeria, you can see 25%.
Mm-hmm.
So, based on my knowledge of what I'm going to spend in 10 years, will it be advisable to start investing in 25% for the future, which take me for less than 3.5 years to double my money, compared to this one that's going to take about 50 years to double my money?
Yeah, but different currencies, right? So different currencies. Let's use your example. Are you going to move back to Nigeria in 10 years?
That's also part of the plan.
Okay, so if you're going to move to Nigeria, then you are at a huge advantage. You can take your pounds, convert your pounds to naira, and start to buy Nigerian assets at a quote-unquote discount today. Because you are not going to go back to pounds. You are going from pounds to naira. You are not going back from naira to pounds, Abi. If you are doing one way, you are coming in as the best investor in Nigeria because you are bringing in your pounds to invest in Nigeria. So you are wonderfully made. You are going to make a lot of money. The problem is if you're going to go back from naira to pound. That was the last question. He was asking, should he do that if he takes his pounds to naira and he's going to go from naira back to pounds? Does it make sense for him? And I answered that because we don't have a forward market for him to hedge that naira back to pounds. We don't know how to calculate if he's going to make a profit. If he comes from pound to naira, he's going to pay how much? Let's say dollar. No, dollar is 14.1450. That's what he will get per dollar. If he invests in Nigeria, he will get maybe like 20%. No problem. But when he goes that 20% to go back to dollar, that's what the wahala is. Because he has to now buy that dollar at a price we do not know. You see the point? Before in Nigeria, we had what we did. We used to have the forward market. You could go to FMDQ and you could buy a dollar forward, which means you could buy dollars 10 years or 5 years ahead today. So for him, if we still had that market, we'll simply go to that market and say, what price will CBN sell us dollar in 10 years' time? If we get that price, then we can walk back and say, is this conversion going to make sense to us? If it makes sense to us, then we buy it. But because there is no forward market, we don't know. So we can make a profit or we can make a loss. What if in 10 years time they tell you there is now foreign restriction, you can't take money out? Then what will you do? Look at the airlines. The airlines in Nigeria made a lot of money, but they couldn't take that money out. That's why they banned Nigeria. So you see the points I'm making. We don't know, so we can't give an opinion on that because we don't know.
Okay. Thank you very much for your claim.
Yeah, you're very welcome. Yeah, I'm so sorry. I know some guys are trying to log in, but yeah, I'm not sure what's happening. I had a Mukhtar here. I had everyone here. You drop off. I'm not sure. So if you want to request again or send me a DM, I will be able to answer your question. But I'm so sorry. I don't know what's up with the. I'm reading your mail. I don't know what's up with the. My link is rather strong, but I'm not sure why you are not able to speak. I apologize on that. A few great questions here on the DMs. YouTube folks are not asking questions, they're just listening. Yeah, thanks for the compliments, Mr. Moses. I appreciate that. Yeah, what else? What is it there? Yeah. So this is another good one. He's asking here, what about insurance? What is the role of insurance in all this? Last time we said that before we invest, we should buy insurance. You are going to talk about insurance today. Yes. So last time we gave you your hierarchy of how you invest, your hierarchy. And we said number one hierarchy is before you invest, you want to plan. And after planning means you determine what kind of investor you are and why you are investing. The next thing we said was you have to buy insurance. We said it's life insurance, but you're not buying for your life. You are trying to link your obligation when you are not there to your payment from the insurance company. And we give the example. Let's say you have a daughter today and you want to then buy life insurance. You're going to ask yourself, how much will it cost to send this daughter to university? If it's going to cost you 20 million and you want to also give her a legacy, maybe 10 million. So you say, okay, I need 30 million should anything happen to my daughter. So you go to an insurance company and you say, hey, insurance company, I want to buy life insurance for 30 million. Then you even do something better. You now go to a trust company. You sign that trust company up as your trustee. You do a trust deed. You tell the trust company, I bought the insurance company. I'm going to put you guys as the beneficiary of my life insurance policy. Not my daughter, not my wife, not my brother, but the trust company. So if anything happens to me, the trust company gets the proceeds of the insurance. The trust company then takes out proceeds of the insurance and invests according to my wishes. It will send my daughter to university, to Harvard, and when she graduates, it will give her the balance of the funds that I've invested for my life insurance. And I say life insurance is the only investment on earth where you can invest 1 naira, and if it happens to you, you are worth 10 million naira. It's the only investment on earth you have like that. But that is part of your overall plan. So number one was plan. Number two was life insurance. Number three, we said look at your emergency fund. We said create an emergency fund of 3 to 6 months of your necessary expenses, not all your expenses, your necessary expenses. So your rent, your fuel, have money set aside in cash or near cash to pay for 3 to 6 months of your necessary expenses. Have that, then you do your retirement. Which means if you're working, you have to do your PF, your RSA or retirement account if you're in Nigeria, or your 401k if you're in America. If you're in America, also do your IRA, individual retirement account. Also do that as well, right? You do that before you invest. This is the investing side. That's what we do this last. You do your insurance. You do your emergency fund. You do your retirement before you invest a kobo. Don't invest before you buy life insurance, before you do emergency fund, before you do retirement. Don't, because if anything happens and you have an emergency, you have to come and sell your bonds to pay for emergency. So that's not going to be the best. So that's why I explained. So that's what we're talking about. That is, we've gone past that. You want to make sure that you are doing your life insurance before you invest anything here. Again, like I told you guys, you can't insure your life. What you are insuring is the loss of income to your dependents. That's what you are insuring. You can't get your life back. But life insurance is a very, very unique tool that you can use to your advantage, right? Fantastic. Oxley, how you doing? Oxley Tech. Okay, I'm going to take you off. All right, fantastic. All right, then I have another question here. This is an interesting question. This guy's asking about the Trump account that he saw last week in America. They were talking about an account that you could invest money in for a child, and the child, what's that all about? That's what he's asking. So in America, we have what we call individual retirement account, right? Which means it's like you can invest yourself for your retirement. They put a cap on it and all that. You can invest yourself. So what they've done is that they've taken that investment, they've made it now for kids. They have a special account for kids. But this account, anybody can invest in this account. Anybody. So if you open an account for your child, I think it's going to be for the kids that are born from next year and the next 5 years or so. I think they will extend it, but I think just for the first, for this kid now. If that kid is born, the parents, the company, anyone that wants to invest in that kid's account can put money in that kid's account. It will grow. It will be invested in the stock market. It will grow, and when the kid grows up, it's for the kid. The kid can then keep on using an account and keep on investing. What they are trying to do is to, number one, introduce kids to investing. Number two, imagine this. Imagine you work for a company, and the company says, as part of your hiring perk, we will contribute money to your child's RSA account. That's that account. So it's a very, very good way to tell workers thank you. You can say, okay, we're going to invest in your child's account. Your child doesn't work for the company, but your child gets that money. That's what Dell is doing. The guy you saw contributing, investing $6.2 billion. He went to the poorest zip codes in America, and he's going to put this money, I think it's $250 in each kid's account. He doesn't know those kids, but if you're from that zip code, you're going to get this account, that you have this money in that account. The money will be invested for you by professionals in the stock market. So those kids are going to wake up in 18 years' time and find they have an account worth $100,000 they knew nothing about. That's what's going to happen. We would have forgotten about this, but in 18 years' time, those kids are going to wake up and I go to them, hey, you have all this money that was given to you by Michael Dell. That's what it's all about. I think that Nigeria should copy it. Something we can copy. We can say, hey, we're going to have an account, and you can invest in that account for your child, and you can't touch the account for the next 20 years, and your child can get that money. And the government will give that account tax benefit, so you can invest, your company can invest, and all that. It's a good way. So instead of doing birthday party, just put money into the kid's account, and it can invest for the kid, and the kid has. That's what they're doing. It's just like an IRA, but it's for kids, and it has tax advantages and professional management. In effect, what they're doing is that the government is saying, if you want to do philanthropy, give us the money, and we'll put the money into the kids' account. Don't go and open up your own trust. So it's cheaper for you to use the government. So Michael Dell could have done this with his own foundation, but instead he just gives this money to the government and says, here, I'm giving you $6.2 billion, give it to all these kids. He's going to get a tax break. He doesn't have any operating cost, so it's cheaper for him and everything, but the kids do get money, so we win for everyone. Yeah. Ugu. How you doing?
I'm doing okay. Thank you, Carlo. I am talking to you from the US, and this is actually the first time that I'm listening to you. I think you mentioned about 401k just a few minutes ago, and I want to find out, like, for students in the US who are yet to start working officially, how soon do you advise that somebody starts saving through 401k, even if you're not yet sure how long you're going to stay, like, in the country. Do you advise that students upon graduation start saving to 401k, even if they are not certain how, about their stay here permanently?
No,
Thank you.
Good question. But you can only have a 401k if you have an employer, because 401k is an employer retirement account. So if you have a job, then you can then qualify for a 401k.
Because last summer I did internship and they provided option for 401k. And
but it's only for 401k is only for qualified employers. Let me just give you the answer, then you can give me your response. You might be able to do what we call an individual retirement account, an IRA, but that IRA has only going to be funded with your salary income. So if you open up an IRA, you can't be, if you work for someone, you can't put your money from your pocket. So if you work anywhere and you open up an IRA, you can then say, I'm contributing money from my salary to that IRA. That's what I think you can do. If you are not working for anyone, i.e. a job that has a 401k, you can't do the 401k, but I believe you can do an IRA. If you have a job, you can just contribute yourself into the IRA.
I understand what you're saying. The thing is, when I did an internship last summer, I was provided the option of saving through 401k, but I also had the option of opting out because I'm an international student, and it's because I'm an international student, they feel like, oh, you may graduate and you want to go back to your country. So you may don't want to save. You don't want any part of your salary to go to 401. So I am now asking, like, do you think it's advisable to start saving immediately? Because I think if I start taking part of my salary to save through 401k, and maybe in the next 3 years or 2 years, and I want to leave the US, or let's say, you don't have, that permit or sponsorship to be here and you want to leave or go somewhere else, does it mean you're going to lose the money that you've saved through 401k? Or there is a way you can still get it back even if you want to leave?
You won't get the money back till a certain age. You have to retire, I believe, till you are 59 and a half before you can get the money. So if you open up the 401k today and you save, what's the advantage for you? It's tax-free. Which means that when the money is invested, they will not charge you a tax. It's tax deferred. But you can't touch the money till a certain age. So the money will remain there. Then you can come back when you hit that age and request for the money to be given to you. That's a disadvantage in quote of that. But ask them if they do a 401k with an IRA. Ask them if they do a 401k with a Roth IRA. Ask them to write it down. Does their 401k allow you to do a Roth IRA? Does that have a Roth 401k? Because when you do that Roth, right, ROTH, you are able to contribute today, pay taxes today, and in 5 years you can get the principal at least back in 5 years. The growth portion, I think, will remain till you are 59 and a half. So find out from them if their 401k has a Roth, if you can contribute via Roth to the 401k. If they do that, then you choose that option. You pay tax today, but when you are after 5 years, you can get the principal amount. You can withdraw the principal amount without paying taxes and without any questions asked. But I think the interest that you've gained will stay in the account till you get to that age. That's what. If you don't have that and you do it, well, you're not going to get it back to a certain age.
Right. Thank you so much. This is very helpful. Thank you.
But overall, I would do it because look at it this way, right? They are matching, right? They're going to match you, right? If you contribute a dollar, they're going to match, right?
Mm-hmm.
So that's free income for you. So I would do it. I mean, what the highest you do maybe 3 or 4 or 5%. I would do the full match. If I don't touch it, that's fine. I make sure I put the beneficiary. Do it. Put the beneficiary. If you live in America, that's fine. You have it there. It's there. It's not going to go away. You might come out to America, you just continue with it, or you transfer to a new fund. If you don't come out to America, when you are retired in Nigeria, you can go back to America and they'll give it to you. So it's not going to go away. It's your money. It's your name. Yeah. So I would do it and get the match from the company, because that's just like the savings account. It goes into your company. And you remember, you might have a remote work tomorrow, and you might be an independent person. And you say, "Oh, I have an account already," and all that. So I would do it, and it's savings. You can't lose with savings. If I'm leaving, how old are you? Below 40, below 30, below 50? How old are you?
Yes, I'm 30.
Mm-hmm. I would just buy an equity ETF and forget about it. I'll buy an equity ETF. I'll do what's called a DRIP. Write that down. DRIP. That's a drip, which means all the dividends, they're going to pay it back to the 401k. I don't want to see any dividends, right? And then I'll forget about it. Buy something that is just going to buy in American stocks. There's something called VTI. That's an ETF. I'm not giving you advice. There's something called VTI. It's going to invest in about 4,900 American companies, the very, very best. There's something called VOO. It's going to invest in just 500 American companies. If you bought that with your ETF, you're 30 years old, you do a drip, so the dividends go back to that portfolio. You forget about it. Leave it alone. It's personally managed. You get the full match. If you get the money, even if they give you the money, don't take the money. Why take the money to? Leave it alone. Leave it there. It's savings, it's saving equity savings for you. Then when you will retire, you can go grab it, yeah?
Right.
Fantastic.
Okay. Thank you so much, Carlo. Thank you.
Hey, you're very welcome, man. Get the book. Go to Amazon, get my book. Most of what I'm telling you is going to be in the book. Be deliberate about it, and also get credit. Go get credit, yeah? So, do you know how to get credit?
What do you mean by credit?
Credit card.
No, I have credit card. Yeah.
Okay. If you also get.
I think I have. For some reason, I feel like I've built the score to a good extent.
What's your score?
754.
Excellent. So you want to keep that score there. You want to do that matching, and then you are set. That's you're an American in quote now. Yeah.
All
right. Perfect. Get the book. It will help you. Go to Amazon, order it. It's $25. It's nothing. Get the book, read it. It will help.
What did you call it again?
Let's talk about your money. Just go to my profile. It's a pinned tweet. You see right there. The book. Get my book. Let's talk about your money. Order it on Amazon. It will enrich you. Yeah.
Definitely, I will check it out. Thank you.
All right. Perfect. I had a guy here just dropped off. So yeah. Sorry guys. I know why you're dropping off. All right. So we might start to wind down. I can't read all the DMs. I'm so sorry. I don't know why you guys want to request to speak. But I will start to wind it down, and then I'll let you guys go watch your stock and all that. Jeez. Okay. Let's take these two questions. He's asking here, Nigerian ETFs. Nigeria has ETFs. Would you recommend I buy Nigerian ETFs the same way I'm buying American ETFs? I think Olumide used to be here. You guys know Olumide, and we asked the same question. The problem with Nigerian ETFs is that they're not that liquid. I'm not sure why, but Nigerian ETFs are not as liquid as the Nigerian mutual funds. So if you're trying to buy into this, if you want to buy equities in Nigeria, the mutual funds are more developed. They are more liquid. They are larger. You have. Let me just say a few names. You have AfriInvest has the mutual funds. IBTC have mutual funds and all that. Meristem, all these guys mostly have mutual funds. So it gives you a way to diversify. You buy one, you diversify into all the Nigerian stocks. So you have diversification. You also have dividend income when you buy a mutual fund in Nigeria, and it's also professionally managed. So I think something you should look into. ETFs, I like them, but in Nigeria they don't really have that much. Liquidity. But money market. Mutual funds seem to be very, very. In Nigeria, they call them unit trust. Sorry. In Nigeria, they call unit trust. America, they call mutual funds. Seems to be a bit more liquid. So I would recommend that if you want to look at that portfolio. Not saying you shouldn't buy the ETF, but I think mutual funds have a bit more. They are a bit more liquid, and they've got a bit more tenure in Nigeria. They have more management and all that. So that's a good question there. Answered that one. The second guy is asking, you talked about property rental. Yeah. So I said rental income. Don't look at the rent. If you are making rent of 1 million, doesn't mean anything. You've got to convert that rent to rental to get rental yield. So you look at the yield, not the naira that is coming to you. So what is the rental yield? That is rental yield is the rent you get. So if you used 100 million naira to build your house and you are getting 10 million naira in rent, the rental yield is going to be 10 million divided by 100 million. That's going to give you 10%. So you compare that 10% with the bond yield or with the dividend yield. That's how you compare real estate to bonds to equities. You don't compare, I got rent of 1 million and the shares are paying me 500,000. No. You convert the rent to a yield. You convert the dividends to a yield. What's dividend yield? The dividend you get divided by how much you used to buy that portfolio. You divide it, then you compare the rental yield with the dividend yield. That's how you compare yield. That's what I was trying to explain. Yeah? Oxley, how you doing? Oxley Tech. Have you fixed your audio now? He still can't speak. Joey, what's up?
Hey, Kalu, good evening.
How you doing?
Yeah, I go straight to the point. Yeah, I live abroad and I have 2 children. Government's paying them monthly. That money I'm just paying savings account. What's the best way to invest it for them?
What country?
UK.
I mean, those kids are. I mean, if you just put that money in an equity fund, what worry?
Okay.
What worry? Just do the equity fund. We do let the dividends go back to the equity fund because we don't know what to invest. Abi, we don't know what to invest. And if you give it to professional managers, you pick an index fund. Hear what I'm saying? Index fund or mutual fund with very very low expenses that is buying the entire market. I don't see how you go wrong with that. So if you pick those two, I think you should be in a good space. I would also try to buy the US market if I can. So I would maybe 50 US, 50 UK or Europe as well. Let me give you this way. Let me give it to you this way, right? You have a piece of paper. So if you want to buy, because they are kids, they are babies, right? Equity is going to be fantastic for them. If you write VT, UK would have a different name for it, but VT means Vanguard. So VT is Vanguard's portfolio of all the stocks in the whole world that are very, very good. That's VT. If you buy VT, you are buying them everything: Nvidia, Samsung, China, Brazil, Nigeria, anything that is good. VT basically is like 10,000 stocks or so. You can do VT. There is VTI. VTI is only stocks in America. I think it's about 4,900 stocks in America. Just America alone. VTI. If you do VXUS, that's all the stocks in the world that are good apart from America. If you do VOO, that's all the stocks in America but just 500 of them. So if you want to build a portfolio for this kid, you can say, okay, I'm going to build them a portfolio. They will have 30% UK, 30% international, and then 40% US. That's a great portfolio for a kid. So he's got the US 40, he's got Europe 30, he's got rest of the world 30. The rest of the world is your Brazil, your Angola, your Nigeria. Then he's got your Taiwan semiconductors, he's got this, then he's got Europe as well, not just UK, Europe. Tidy portfolio for a kid, rebalance when they get to 18 and see what's happening here. Reinvest all the dividends. All right, Sir Ian, what's happening, man?
Hi, Carlo. Good evening or good morning, wherever you are. I'm good. So I was curious when you mentioned investing in life insurance, and I was also a bit skeptical when it comes to what market and what country that investment is made in. And I'm picking a personal experience right now where there was a time, I mean, my father was enslaved, and it took me up to 6 years to get his retirement savings All right. And the 6 years I'm talking about was me basically going to one office to the other every other month. And I was able to have the patience to complete that because I'm someone who I usually like to finish what I started. Now, if we have a government or a system where if somebody dies, the guys managing the funds do not reach out to the beneficiaries, or do not accept or make it easy for the beneficiaries to have access to such a fund. How would you advise again about this insurance or life insurance thing for a market like Nigeria?
So I would just say you bring up a good point, because in the end, if you are investing for 20 years, then the person you are giving your money to is very, very important. So if it was possible to invest in international insurance companies that have their name to protect, I would go for that, right? So in Nigeria, I think that one or two insurance companies that have this international exposure, essentially you are buying trust. You are saying, will this guy be here in 20 years? That's really what you're trying to do. And there are a few that are out there in Nigeria that, either they're international or they have a very, very long history, right? That's what I would go for, because you are buying, you won't be there. So you are buying, that's what I would advise you. I don't know. So if it was possible to buy foreign insurance companies and do this exact same thing, I would do it, but I don't know if it's possible in Nigeria to do that. It's the same thing with HMOs. Some companies offer HMOs that are from abroad, and some offer HMOs are from Nigeria. If you have the money and you can do the foreign one, do it. If you can't, look for a very, very good Nigerian one that has gone with good, good reviews and all. That's how you raise risk. There's no other way, There's no other way, because tomorrow we don't know what's going to happen tomorrow. Let me ask you a question. When you say your dad's pension took you 6 years, was it the RSA or was it the old scheme, like the old pension? RSA shouldn't take you more than 6 months.
Oh my God! It took me 6 years since 2017.
Was it RSA? You had an RSA.
RSA. I don't know if I'm permitted to mention the pension company. But the problems I had was with the government and the RSA. So I had to be moving from different offices every other month.
What were you doing?
Some documents that I provided, they would ask me to go again to make sure that I get the same document provided. In fact, they asked for saying that if I were not close to my dad, I wouldn't have been able to have access to those things.
What are they asking for? What are they asking for? Give me an example.
Oh man. So they would ask for me to go look for the letter of application, the letter of employment that my father got where he works.
I see.
They asked for that. Then they will ask for me to go and get a letter from the company, the letter that was given to him the day he stopped working in that company.
Was he working for the government or for a private company?
Private company.
What the heck?
And if you can't provide that, no way. Now, if you go, then I would go to this office. Of course, he might have left the office long ago. People that knew him were probably no more working there. And these same people in the office would tell me that, we can't do that because, we don't know if you are the real son or not. And then I would be like, okay, don't you have records? They don't have records. Even the records that they have, everything is just a problem. It's just so difficult. So my question is, the RSA, the pension companies, right? They notice that this man has not received maybe funding in his account for over 6 years now, and someone has come forward that matches the next of kin, all the details in their system. Why can't they speed up the process? So that thing makes me a bit skeptical about insurance and all these things in this market. You've answered the question I asked, but the other question I have is for someone who has the interest to be outside of a particular market or country, maybe in 5 years' time, where do you advise that the person actively invest in, either in dollars or in naira?
So let's go back to that pension thing. So I think what's very, very important is that the PFA guys have a very, very laid out criteria to pay you money. I'm surprised to see a private company and you will have difficulty. I'm really surprised because they have very, very stringent, if they don't pay you, they get into trouble. And they have a set criteria of what they have to use to pay you. The funds are in his name, not in the company name. The funds are in his name. All you need as a beneficiary to say, I am the beneficiary of this man's money. You get it with life insurance. So I'm shocked what you're saying. Send me a DM. Send me, I mean, because once you do the RSA, you have life insurance. If the person passes away, all that is paid to next of kin. It's a set criteria. Bring this, they pay you. End of story. The delay usually comes when you are a government official. Then they want to get the government share of your past benefits and pay to your RSA before they give you. That's where the delay is. But if it's just a personal guy has passed on, he has an RSA in his name, I don't know where it's coming from.
You'll be surprised what Nigerians
Send me a DM. Send me a DM. I will talk to...
But I've received the funds though.
Okay. Then your second question, you're asking me if you have to invest in dollar or
in naira, depending on where one wants to be in the next 5 years.
Like I said, invest in the currency you want to spend. I've said that before because if you the naira is not convertible. When I mean convertible, if you Google what convertible means, it's not convertible, which means you have to literally physically change naira to dollar. The people that are good, the guys that are enjoying Nigeria today are Nigerians that are earning dollars. They have no problem because they just have one way. They earn dollar, they convert to naira, they spend naira. They're not looking at investing back in dollar terms, right? So they don't have a problem. They are basically buying Nigeria at a discount. The problem comes when you want to go back from naira back to dollar. That's what the problem in Nigeria is. If there was no going back, we don't have any problem in that. So I would say if you're earning a foreign currency, Nigeria is at a discount, it's on sale. You shouldn't buy everything you see in Nigeria. Nigeria is on sale. I would just keep on buying bonds, stocks, property because it's at a discount. The wahala comes when you want to go back because then you have to convert it to a currency. So if you want to stay in the country, fantastic, don't go back, stay here. When I mean stay, I mean the investment is not going to leave Nigeria. Nigerian bonds, there are some bonds that are paying 9% in dollar terms, which is so high. 9. So a foreigner would borrow money from Japan at 0%. Come to Nigeria and buy our federal government bonds at 8% for 30 years. That guy is on easy street. He's just going to go to the beach and earn 7% margin for 30 years. It's crazy. So if you're not sure, that's why the US, the safest investment on earth is the 10-year treasury note issued by the US Fed. Because we don't know what will happen tomorrow. Because we don't know what will happen tomorrow, we run for safety of the US Fed. That's why it's safe. Nigeria is paying you high returns because Nigeria is quote-unquote risky. So like if you go back to our football analogy, Nigeria has got only attackers. They don't have defenders. Because we didn't do what we're supposed to have done. So we now have attackers. That's why we're offering high rates for people to come and invest. But look at Japan. Japan rates are 0. Swiss rates are 1 to 0. USA is 1 to 2. Because they have a lot of defenders. They have invested in their country. They don't need attackers anymore. But when you are chasing the game, you need attackers. That's what Nigeria is doing. So if you're not going to go back, perfect opportunity for you. But if you're going to go back, you have to do your numbers very, very well before you don't get in trouble. All right. Hey, welcome, man. We've got about 10 minutes to go, then we'll call it a day. Oxley Tech, calling you for the 15th time. How you doing? Can you speak now? Or go to Kenny? Oxley, you gotta fix that mic. Today is not your day. Kenny 234.
Yeah, thank you. Thank you, Carlo. I have a question about properties. If you bought properties and you're using it for like Airbnb, or what we're doing now is not Airbnb. We are doing
we're doing leasing, short lease.
Huh?
Short lease.
Yeah, we're doing a short lease, leasing to like contract nursing and all of that.
Yeah.
Doctors. So But then I'm sorry for bringing politics into it. Then I saw what this Letitia James of a thing, not signed when he was getting a loan for the housing that he did not disclose. He's going to use it for renting. And I never asked those questions at the time of acquiring those properties. So, and I'm scared to go ask. How do you rectify those type of problem?
Did you buy that? Is it your first property or your second property?
I mean, I'm on 3 now. Okay. So
Letitia's problem.
And I never, in each of them, I never, asked those questions.
Okay, her problem is not that she didn't ask disclose if it was being rented. Her problem is that when she took the loan, she said the property was going to be her primary residence. You know, in America, when you say a property is your primary residence, you get a lower interest rate. So what she was doing, what they alleged that she was doing is that she was getting properties and claiming they were her primary residence, so she should get a lower interest rate on the mortgage. That's what they were claiming. So that's why the rental comes into play. Because if it's her primary residence, then she can't have tenants in that house. That's why they are bringing the tenants. It's not because of the tenants. It's because they are alleging that she said it was going to be used as a primary residence. Hence, she cannot have tenants in the home. Yeah, so as long as you don't have a problem if you took the property for rent, it doesn't matter. Just make sure that when you do the application, you're going to ask you, is it a prime residence or is it an investment property? Most people will say primary because they want to get a lower interest rate. America keeps records. They don't care about you, Kenny. But when you run for Senate, they're going to bring that record up.
Okay, I see. Yeah. Because we use it's kind of a private homes, all those homes that you just rent it out. But I guess I would depend on they are not coming after you except if you're going for public stuff.
Yeah, just in America, my rules always just tell the truth, because these guys they'll ask you a question and they file it away. Then they bring it up 10 years. I've gone to the airport once and the guy said, "What are you here for?" I said, what did I tell the guy? I said, I came for a holiday. But the guy said, okay. Then the guy said, "Where are you going to stay?" I gave him a phone number. He called. It was the wife. And I had shoes, female shoes in the bag. Do you know what he told her? "Do you know your husband is bringing back female shoes to the United States?" Why was he telling her? So that she would get mad and then spill the beans. You see? So this guy is very, very tricky. So she was like, no, those are my shoes. I asked him to bring it. But then he came back and told me, "Why didn't you say you were married?" I said, "You didn't ask. You didn't ask." He said, "What am I here for?" I said, "I'm here on holiday." He said, "Yeah, but you're going on holiday." I said, "No, but you didn't ask." Then the other guy said, "Oh, you didn't ask him that. You just asked him what you're here for." So anything you tell the federal officer, if you lie, it's a criminal offense. Anything, you know that, Kenny. So anything, anything. So if they ask you, is your home a primary mortgage, and you say it's a primary one, is an investment, you've lied. They don't have to put the lie there, but 10 years time, you want to run for Senate.
The thing I was talking is that, Furnish Finder, right?
What is Furnish Finder?
Furnish Finder, that's the one that I'm doing. You kind of, it's a short time rent. But then at the end of the day, it could go for years. It could go for. It's mostly for healthcare contract workers. You rent to healthcare contract workers.
Yeah.
Strictly healthcare contract workers. So you could carve out a place even in your residence to kind of do those type of business.
It doesn't matter. As long as when you apply for the loan, And you can go back and amend it. You can go back and say, oh, I applied for this loan as a prime residence, but now I'm using it as an investment property. You can go back and amend it. That's fine. The point is, if you say something and they find out, then they'll say you lied. That's what they are using against her. Yeah, that's just it. So I don't think for you, yeah. But remember, look how they're doing to Somalis now. Look at what they're doing to Somalis now. So many of them came in and said lots of quote unquote things that they are finding out today were not true. And those guys might be up for deportation. Remember what they're doing to them now. Many people came and said, my kids had autism and we're getting...
no, I'm not anywhere close to that. It's just based on the property and that, that development of Letitia James that I'm, but okay. Thank you so much.
You're welcome, man. All right, fantastic, guys. So we'll spend 2 hours here. Believe it or not, guys, 2 hours. Also, anytime you can speak, just speak, because... It's not going to work for you, my brother. I'm so sorry about that. One of my guests, but I'm not sure it's not working for you. Sorry, yeah. So we'll spend 2 hours here talking really about linking up everything. Let me just do a summary that we'll call today. So the first one we had was financial health check, income and expenditures. We talked around your income. We said create 2 income lines, your active line and your passive line. And we define active as income you get when you are physically working. You have to be there to get active income. We define passive income as income that you have to get when you are not there. So things like your dividends, your rental income, things that you get but you are not there, that's your passive income. The learning there for us is that we want to use our active income to grow our passive income. That's how we're working. We want to convert all active income into passive income. Why? Because when we retire, we want to pay our expenses with our passive income. The whole idea of working is to generate passive income from investment. We then went to assets and liabilities. We said assets give you cash flow, liabilities take away cash flow from you. We're not giving an accounting definition, just more financial planning and cash flow definition. We then said we want to make sure that if we are taking any interest-bearing liability, it is to create an income-generating asset. Debt is good or bad only if that debt is being used to generate income-generating assets. So we said when you compare your assets to your liabilities, we want to get a net worth. And that net worth, we want to convert how it is being funded from debt to passive income as the years go by. So that we've done income, we've done asset. Now we're doing investment. And we're making the point with investment again that you want to invest according to your objectives. Now, if you start late, you are going to be in a bit of a trouble because you're not going to be chasing the game. You're going to be using more attackers to try to make returns that you have made earlier. We said you want to invest according to your objectives, your age, your risk profile. If you are younger, you have the opportunity to have more compounding periods. So you want to do more of equities that allow you to grow your principal over time. If you're getting older, balance it out and do more of fixed income. The idea is not equities are not better than fixed income, but because of your circumstance, you have to diversify and be overweight in fixed income or in equities based on your age, your objective, and of course your risk profile. That's what we talked about all through today. A lot of questions back and forth. So I hope you guys have learned one or two things from today. We're going to do the next time we meet, we'll try to do a checklist for the entire year. What have you done in 2025? Let's review our checklist. What should you have done in 2025 so you are getting ready for your 2026 year and it's just perfect for you. Next time is going to be, I think, 7th, so it's going to be about the 14th, which means next week will be Christmas. I'm not sure we're going to meet during Christmas, but we'll try to do that checklist for you in case nothing comes up. That's what we're going to do when we meet again, 7 p.m. West African time. So thank you guys for being here, hanging out with us, talking money, finance, and of course the economy with me. I appreciate you guys. Ensure you get the book. There are many books you can get to learn about financial planning. If you don't buy a book, go to YouTube. Just put any question you have on YouTube. How can I learn this? You see tons of free videos. So you got lots of free resources. Go to Bloomberg, get podcasts, and listen to me. Anything you listen to once or two times an hour a day, you become an expert in it. You got to learn about money because it's got some terms and some principles that you have to basically know so you know how to essentially invest. I give you a good example. If you want to buy a bond, do you look at the coupon or do you look at the yield? If you been in this class today, your son will look at the yield and not the coupon. But you wouldn't have known this if you weren't here. So the more you learn about money, the more it's better for you. So try to read. If you want a good book recommendation, there are tons of them. I have a book, Let's Talk About Your Money. You can get that. And if you go to #FinPlan Books, I create lots of financial planning books there as well that you can buy and also read, and that will basically also help you. On that note, guys, I'll see you all next week when we're back here, same time, 7 p.m. West African time, with me, Carlo Ajawa. We're going to talk again about financial planning, the economy, and of course, finance. Till then, you guys have a good day. I'll see you guys here. Have a good one, and bye.
Bye for now.
Thank you, sir. Appreciate you.